Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The key feature here over the last few months had been the late April to date descending wedge pattern, currently at 23.14 to 23.54. However, the latest iteration of a descending wedge pattern has been an evolution from an original sideways triangle into a descending wedge pattern and maybe into something else, which I will discuss shortly. You see, in early June, this market broke out over the upper trend line, then turned around and dropped back down below the lower trend line in late June, then to turn back up again in early July, through the descending wedge pattern, push up through the upper trend line, only at the start of last week to turn back down with an indecisive spinning top that was also a bearish harami and even possibly a shooting star pattern type 1 bearish. So all in all, we've had two seeming false breaks on the upside and one on the downside since early June. And during this sashaying back and forth, prices peaked at the March 2012 high at 26.20 and dipped to the significant Fibonacci congestion at 22.35, almost testing the rising long moving average at 22.06 before pulling back up again at the start of last week, to the combination of the 38.2% absolute Fibonacci line at 24.88 and the then declining short medium moving average, currently at 24.69, before turning back down to where we are on a congestion zone between 23.72 to 2400, made up from the 50% Fibonacci line of the March to April move at 23.72, the July 2012 high at 24 even, and the nearby rising medium moving average, currently at 24.15. Looking at where we are now, we have below three supports that halted, or let's say influenced the halting of the decline in late June and are still relevant now. The first was something I had been rattling on about for months. It was the interesting neckline, currently at 22.98, which I had highlighted in bright red on my daily chart. In the early part of 2023, this had acted as an attractor for the market, and I think in late June, this was the first application of the brakes on the move lower. Secondly was the combination of the lesser Fibonacci line at 22.35 and the high from back in February at 22.36. This is denoted by a thicker consolidated blue horizontal line. This was the main breaking action on the move lower, as we only had the one close below it before turning back up. The third was something I'd already mentioned, the rising long moving average, currently at 21.78. This was not tested, but its mere presence nearby, I am sure, influenced the market to halt its decline and turn higher. Meanwhile, on the top side, we have the previously mentioned 38.2% absolute Fibonacci line, the declining short medium moving average, and the March 2012 high. As I said 2 weeks ago, and I quote, "All this action has caused me to retire both the upside and downside targets for the descending wedge pattern. They now look pretty pathetic given the significant false breaks both higher and lower." End of quote. So where does that leave us now? Well, we can look at two ideas, neither of which is that great, to be honest. The first idea is to look at the action since the start of May as a possible bear channel, currently 23.14 to 25.78. Immediately you can see how wrong this can be, with the break below the lower bear channel in July, and I will not speak further on this at this time. The second idea is to regard the action since the peak in late June as part of a possible bear flag action. Now, this is dependent on the market carrying on further lower, below June's low, which seems unlikely at this time. There is the opportunity for the action since May to make an out-of-position reverse head and shoulders pattern, but that is even more remote than the two previously mentioned. Now, I did what I normally do when I don't see a pattern on the daily chart, so I went to look at the longer term charts, and these really didn't provide much help either. We still have open overhead, target X1 in the 28 even area from the base of the diamond bottom back in early 2020. That is the result of a bullish halfway hesitation pattern between 2020 to date. Last month and the month before were pullbacks from trying higher, but July is proving more resilient to downward pressure for base of support, possibly on the long-term lesser Fibonacci line at 22.35 and an overhead resistance from the 38.2% absolute Fibonacci line at 2488. There's a possibility for a huge rounded bottom formed from 2011 to date, but it depends on the 28 even area not being an obstacle on any attempt higher. The one thing, and that's really the lookout from the long-term charts, the one thing I suspect we may see is that the market visiting once again the bright red trend line, the red neckline even, on my daily chart, which is currently at 22.98. Ice Europe white sugar in London. I've been discussing here at length some of the big patterns that have showed themselves in recent times. My last idea was to look at the action since April as a possible domed house and three peaks pattern. Even now, this is still not a great example of such a pattern, but it's still the closest pattern to the market action. The drop in late June ties in with this idea, but it also opened up the opportunity for another pattern, a possible mid-May to date descending expanding wedge pattern, currently 532.30 to 691.10. It is a large pattern, and I've chosen for now not to outline it, but it has merit. The latest effort have been attempts in the middle of July and also separately last week at the topside trend line. This had to some degree been negated by that changeover. The only issue with this idea is that I may have to set aside target X at 601 below. This is the harder to reach secondary target to the whole mid-March, early June double top, even Adam type. The primary target in the 630 area has already been achieved, but we still have this harder secondary target X sitting below. By the way, there is an obvious and very good reason why prices did not manage to reach down to target X. You see, as I've often pointed out, below we have a significant and important neckline currently at 621.10 of the August to December 2021 complex head and shoulders top, which is highlighted in bright red on my daily chart. Plus, just below, the rising long moving average, currently 609.60. These two turned the market higher back at the end of June. The question now is, will prices proceed back down to the bright red neckline and the long moving average? And what will they do then, should they get down there? I would only add one further comment, and that is whether the action since the double top, whether the price action has formed a possible reverse head and shoulders pattern, either a continuation pattern or an out of place spacing action. I'm so not liking this idea, but it's not about me liking or not, but about what it may or may not be. Apart from that, keep a very close eye on this possible descending expanding wedge pattern. Sugar white premium spread. We're over halfway into 2023 and this chart is still one of the busiest and most colourful charts I have. Many things are still going on, all at the same time. Okay, so I'd previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart. This is still valid, with the market at the moment in between the lower time below, currently 107 even, and the middle time above, currently 181 and a quarter. I have said this so many times before, and I will repeat it again today. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle attack of this market. Next, we have an ascending expanding wedge pattern, highlighted in bright red trend lines and above the current market. This was formed between mid-April to late November last year, currently 194.5 to right off the top of my weekly chart. To me, it was and still is not the best looking pattern of such, well, not the best looking wedge pattern. But it is also still out there, despite being tested as recently as mid-April this year, and it comes with all the possibilities such a pattern invokes. The most recent activity had been the market's actions around all the moving averages, notably the long moving average, currently 130 and 3/4, the medium moving average, currently 135 even. We have earlier seen activity push down through the two 50% Fibonacci lines at 128 and 3/4 and 131.5, and the June 2020 high at 134 even. But then most recently back up over all of them and up to the congestion between 152 and 3/4 to 155 even, which is made up from the lesser Fibonacci lines as well as the 2013 high at 152 3/4 and the neckline currently 153 3/4 of the June 2021 to May 2022 reverse head and shoulders bottom, which is highlighted in pink on my daily chart. I'll put a question mark against this last point as it seems to work just when it feels like it. It's not consistent. Now, 7 weeks ago, I drew both a bullish Andrews and a bullish shift picture for the August 2021 to February 2023 action. And I've chosen once again not to highlight either of them as they neither add nor subtract from the current picture. Though the lower tine of the bullish shift picture, currently at 127 3/4, has shown some promise as a potential support. Okay, so the final point I'd like to discuss is a big picture item, one I'd mentioned 7 weeks ago. It was to look at the whole of the 2022 to date action as a possible huge lopsided diamond pattern. 7 weeks ago, I just lodged that idea in my own and in your mind, as there are elements of such a pattern here, but there seemed to be enough going on elsewhere that I didn't wish it to unnecessarily add to the mess of the lines. However, 6 weeks ago, I decided instead to go ahead and draw this potential diamond top pattern here, which you can see highlighted in dark green on my daily chart. As you can see, prices have broken out of the bottom of this pattern, and for a while it looked like the market was going to follow through lower for the diamond pattern, long enough for me to set up some potential targets below, for primary target X in the 47.5 zone, and a secondary, much harder to reach target X1. Well, that X1 would be below 0. I'm very tempted right now to set aside both of these targets as even the primary one, well, that would require a huge move lower, and all we have seen since mid-June is a false break lower.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.